Imagine a time when over 200 local banks issued their own currency, fueling both innovation and economic chaos. Today, we'll examine the rise and fall of US bank-issued notes during the 18th and 19th century, show that inherent structural flaws and decentralization management doomed them, while offering vital lessons for modern digital finance, especially in comparison with Bitcoin. We evaluate insurance, backing, liquidity, fungibility, and centralization, paving the way for historical analysis as we proceed. In the early United States, a fragmented monetary system and stark regional disparities drive significant economic challenges. Lacking a centralized financial authority, local banks and state governments issued their own currency to overcome an unreliable money supply. This patchwork approach aimed to facilitate trade and stimulate local growth amid economic uncertainty. Frequent banking crises and trade barriers further underscores the urgent need for these stopgap measures, promoting rapid adoption of diverse banknotes with distinctive design and security features. Officials of this period banknotes will emphasize their unique attributes. While this decentralized issuance temporarily improved liquidity, it also introduced structural vulnerabilities that ultimately precipitate their collapse, laying the groundwork for future monetary reforms. Bank-issued notes at that time featured security measures aimed at restoring public trust during economic turbulence. Advanced watermarks and unique signatures, exemplified by issues from banks in New England, marked a significant departure from earlier, simpler methods. Regional experimentation with intricate carvings and diverse paper quality built a unique local identity, yet also produced significant verification challenges. Initially, these enhancements boost customer confidence and facilitated trade. However, they opened doors for counterfeiting and mismanagement. It not only destabilized the currency system over time, but also provides key insights when comparing historical flaws to today's digital solutions like Bitcoin. The collapse divided into three phases. First is the initial surge. Regional banks rushed to issue currency to overcome fragmented trade barriers, as seen in the proliferation of diverse notes in New England and Mid-Atlantic. This period was marked by overabundance of local tailored yet inconsistent banknotes created to address urgent economic needs. In the mid-phase, financial crises such as the Panic of 1837 and the Panic of 1893, along with notable local banks' failures, exposed these systemic weaknesses and triggered severe liquidity shortages and dispute everyday commerce. In the terminal phase, chronic decentralized management and inconsistent standards lead to delayed regulatory response, creating a feedback loop that accelerated market disintegration. The collapse is driven by intertwined structural flaws and managerial oversight. Not only damaged public trust, but also sets the stage of evaluating whether Bitcoin's modern design could have prevented such events. Bitcoin offers innovative solutions to 19th century banknote flaws. Its algorithm-driven issuance ensures a predictable supply. Unlike the unpredictable, regionally verified printing of traditional banknotes, its blockchain trusts through cryptographic validations rather than relying on physical backing or government guarantees, overcoming the credibility of historical currency. Moreover, while digital marketplace enhance Bitcoin's liquidity and fungibility, its inherent volatility can dispute everyday transactions and investors' confidence, a modern challenge that mirrors past liquidity issues. Additionally, Bitcoin's decentralized ledger mitigates the managerial pitfall of mismanagement endemic to the broken system of banknotes. Yet, current regulatory uncertainties and market adoption debates underscores its limitation. Thus, it becomes clear that Bitcoin could resolve many structural issues observed in historical currencies. To conclude, we learned that the evolution and collapse of bank-issued notes underscores how uncontrolled issuance and fragmented management erode trust. Issues only partially resolved by Bitcoin's algorithmic control and decentralized validation. Yet, Bitcoin's volatility and regulatory gaps reminds us that robust innovation must pair with effective oversight, guiding future financial reforms and policy.